Hi, my name is Scott Gibson with Beneath the Surface. I'm here with Gene Arensburg of Got Gold Report. Gene, thanks for being with us.
Great to be here, Scott.
I want to talk to you a little bit about your specialty, gold, and get into a few of the stocks that you like right now and talk a little bit about your expectations going forward. But first, what are your thoughts on gold, where it is right now?
Well, are we talking short term or longer term?
Yeah, how did we get here over the last year and a half, and what's your take in the short term coming forward?
Well, you know what I do in my short-term trading, basically what I'm doing is I'm following the largest traders in the world on the COMEX, the natural hedgers, the bullion banks, the dealers, the folks that have to hedge their positions. And when there are very large hedge positions in place, I call them the big sellers, or when they have large hedge positions, we keep our stops really tight. When they have very small hedge positions relative to the size of the market, we call that the relative commercial net short position. When they're small, then we feel more, we feel like we should be increasing our positions, or at least trying to take a position if we don't have a short-term position. Longer term, there's been so much monetary inflation. The United States printing money, the United States, the Bank of England, the Bank of Japan, I don't think gold has quite caught up, excuse me, with the monetary inflation. And it's still trying to catch up. I'll give you an example. If you look at the adjusted monetary base, for example, which some analysts like to look at, it hasn't really expanded this year. So why did gold go up? Well, it's going up because it's still trying to catch up. You know, I think that M2 is something, I don't know the actual number, but I think M2 is somewhere around 12 or 13 trillion now in a $16 trillion economy. And so that ought to tell you something about the currency, and it's why the dollar is 1,700 and something of an ounce of gold now instead of 1/35 of an ounce of gold where it started.
And you see gold is sort of undervalued right now relative to the US dollar and the overall market. What's your take going forward then, short, medium, long term?
Well, first of all, I think we need to think in terms of valuing everything else in terms of gold instead of trying to get that relationship between the dollar and the other currencies. That sort of doesn't really matter anymore. Gold is, or I should say, the other currencies are losing value relative to gold at a pretty steady pace. I call it the race to debase.
Yeah, competitive devaluation of the currencies, and if they're all moving down at close to the same rate, you don't really notice it.
And if you think about it, I mean, you know, why wouldn't the government want the price of gold to go higher? Because it makes all of that debt, that $16 trillion of debt for the United States, and I don't even know the numbers anymore in Europe. It makes all that debt easier to repay. And so, you know, in my way of thinking, I mean, there's this line of thinking that the government is out to suppress the price of gold. Well, that doesn't make any sense, does it? I mean, if they can get the price of gold up, well, it sure makes that debt easier to pay in dollars. I love what Hugh Hendry, the fund manager of Eclectica funds, he's kind of a genius. Not kind of a genius, he is a genius. I love what he says about gold. He said it took God 1 billion years to create an ounce of gold, but Dr. Bernanke can create $1 billion in a nanosecond. So that tells you something about the value of gold.
That's true. And where do you see gold going? Do you see over the next, say, couple of years?
I think if you just extend the trend lines out from what we've experienced since 2002, there's a really good case to be made that gold should eclipse somewhere around $2,300 in the next year. Let's just say that's where we are upside relative to dollars, absent a black swan. You know, does it have a downside? Yes. And who knows, if we get a black swan event, we could see 30% volatility from gold at any particular point in time. But I think that's about all of it, because people need that ability to have something of value that doesn't go away, that can't go away, and that's what they'll run to. You know, we see these psychotic breaks, as Rick Rule calls them, which, what a great term. And you see that, and there's this instant rush to liquidity where people rush into the US dollar or whatever currency they have to work with. And you see that, but then you see gold reestablishing itself as the real safe haven very shortly after that. So my advice to people is, if we get another psychotic break, just ride the storm. If you have, like most of us now, if you have some physical gold and everything, don't get scared. That you want to hang on to that physical gold. That's your anchor.
Yeah, exactly. And from there, what do you think about the various different gold stocks? And specifically, what do you look for when you're looking at gold stocks? What are you looking for in terms of your acquisitions?
Well, right now I'm focused on the highly speculative portion of my portfolio. For a small portion of my assets, I like to work with the small junior miners, and especially the ones right now that have just been crushed. And there's good reasons for it. We can understand what the reasons are. But the ones that have discovered some resources, that have some good NI 43-101 resources, but because they were owned heavily by the funds, the investment houses, especially in Canada, they were all getting redemptions from, say, February to June, or certainly May. And they all got crushed. There was a negative liquidity event. Is almost as bad as it was in 2008. And if you think about it, if you use the CDNX, the Canadian Venture Exchange Index, as your benchmark, the CDNX in June traded down to levels that we were trading in 2002, when gold was $350 an ounce and silver was under $5 an ounce. Now, does that make any sense with $1,700 gold and $30-something silver?
No, it could be the buying opportunity of a lifetime, or at least since 2008, we've been given 2 chances at it.
I really think, Scott, that this is the new 2009, or this is the echo of 2008. And my topic on Saturday is say goodbye to the junior market from hell. Now, I don't really know if this is a dead cat bounce that we have right now, or if we've already seen the bottom in July. But it doesn't matter. If this is the third leg down, we've already traded down to where gold was $350 an ounce. Well, how much farther down can we go? And I love the saying, you can't get hurt too bad jumping out of a basement window. So I'm focused on a very few juniors that have I've at least done the research. I've looked at them. I like them, and I've started taking positions. For example, there's a company that's working in Burkina Faso, and it's sandwiched kind of in between Orzone's Bambaré and Riverstone's Ligidi project, kind of next to Volta. Where in that little 30-click area, there's like 12 million ounces of resources that somebody could put together for not much money right now, because they're all cheap.
I own 2 of those 3 companies, just not Volta right now.
I happen to own the one I'm about to mention, Channel Resources, which they've proved up about a little over 1 million ounces of gold. And you could do a cutoff with them where the average grade is a little over 1 gram, and it's still over 1 million ounces. And they've just been clocked because of a former financer, I won't mention any names, had a change of mind, and they have been hitting the bid for about 4 months now, and they've got to be just about out of shares.
I do own that one as well, and for me, what I'm looking at is very similar to you, looking for companies with 1 million ounces or more, and a gram cutoff, or a gram gold or more as well. And they fall right into that category, and trading under 10 cents is very attractive.
Yes, and yes, they've got more shares out than you'd like, but you don't argue too much about that with a 7-cent stock. But isn't it interesting, Scott, how people just don't want anything to do with it when it's at 7 cents, but they'll jump all over it at 70?
Yeah, exactly. I'll buy it all day long under 10 cents, and yeah, I'll be selling it to those people when it's at 70 cents.
There's another one that I've recently become interested in. It's in Brazil. It's a company called Brazilian Gold. BGC is the symbol. And by the way, Channel Resources is CHU. They're both on the venture. Brazilian has, in all categories, all resources, a little over 2 million ounces of gold that they've already proved up. Plenty of blue sky. They're in a favorable environment. They're working with easy to work with saprolite down there. It's kind of like the stuff that's in Venezuela. Easy to mine, just with a little bit better government. Not a little bit better, a lot better government. And I've just kind of warmed up to the story, but now I'm interested enough in it to start building a position. They were bought, or they did a financing over $1. I don't remember the exact figure, but with Tocqueville and Sprott, some of the better houses in Canada, and now they're trading in the 19-cent range, something like that. But they were crushed because the funds got so many redemptions. They've got the resources, and this is a story where, yeah, they got knocked down, but no, the world's not coming to an end. So why don't we go ahead and take our vulture position here, and when the market gets its senses back, it'll do just fine.
I don't own that one, but I will check it out.
They're here at the conference. I certainly enjoyed my talk with them. And Ian Stalker is there, and this is a fellow that's been around. He was formerly with Goldfields. He's, I think, put in 7 mines in his career.
Yeah.
So
they've got management, they've got the resource, they've got the grade, got a low share price, low valuation. So very attractive.
I think it's a little over 100 million shares out. I said, Ian, what could go wrong? And he said that the only thing that he's worried about is the price of gold going down.
That's a good comment to make with all us gold bugs. What's your take on share structure? I just want to talk a little bit about that. Back in 2001, 2002, you really wanted to see companies with less than 20 million shares out. Nowadays, maybe 50 million is a more expected number. But 100 million shares, a lot of investors get discouraged when they see that kind of a number or higher. What's your take on that for these companies?
I really think you just have to say it's all about market cap. The number of shares is sort of a measure, just like a dollar is a measure of price. So is the number of shares out, and so is the amount of what's the word I'm looking for? Not liquidity, but the amount of leverage that you have with a company is the share structure. So if there's a lot of shares out, for example, Andina Mineral, or some of the other companies that have a really large. It's hard for me to get interested in those. I do follow them, but it's just, where's the leverage left in that?
Right, but you look at something like Brazilian Gold where they have, just over 100 million shares, around 20 cents. So, hey, 20 million market cap for 2 million ounces of gold, and that used to trade at least 50, if not 100 million in terms of a market cap. You're looking at some upside potential there.
Right, so you've got a lot of shares out, but you've also got a lot of upside. So, of course, we would love if it was 19 cents a share and 30 million shares out.
Right.
But that's not the way it is.
You take what you get. The valuations are what they are. But thanks very much, Gene. I really appreciate you being here with us.
It's great to see you again, Scott.
Again, that's Gene Arensburg with Got Gold Report. My name is Scott Gibson with Beneath the Surface.